Hi, I'm Jeff Sailing. I am co-founder and executive director at Startup MB. We are a nonprofit startup accelerator and incubator that's affiliated with several venture funds that invest in the startups that we help. Today, we're going to be talking about valuations, valuations of your company, valuation caps, and a tool that we've created for founders and investors alike to use to figure out what the right valuation is for either your investment, if you're an investor, or for your company, if you're a founder. So now let's take a look at the actual tool itself to show you how to calculate an appropriate valuation from an investor point of view. And if you are an investor, you should be thinking about this too, making sure you're investing at a valuation that can return you an appropriate amount of money given the risk that you're taking. So let's get started. First thing that you want to know is the investment amount requested. Some people think of this as their round size. Other people will think of it just as what they're asking for within a larger round. The math works the same either way, so you can use either one. In this example, we're asking for $100,000. The next thing to figure out is what is the return multiple? You can see we have a drop down with a series of numbers here from 5 to 50x. If you want to be kind of in the middle, you can maybe choose a 40x return. I would suggest that you stay away from the 5x and the lower numbers if you're in the pre-seed or the seed range of investing. The next one we have is the industry sales multiple. And what this is the amount that you would be offered for an acquisition for your company as a multiple of the amount of sales that you have. And the reason that this is important is it is one of the more serious determining factors as to what you will get for your startup. Where can you find things like this? You can do research on other companies like yours that have been acquired recently. Some of this information is available on Crunchbase and PitchBook and a lot of other places out on the internet where you can figure out what would somebody pay me for my company as a multiple of the sales. And the reason we use this rather than a multiple of your profits or your EBITDA is because most companies, most startup companies, when they're acquired, they aren't at profit. So they don't have a multiple of EBITDA, but they do have sales. So a pretty common multiple for sales is the 4x that you see us using here. If you're in an industry that has a better multiple, good for you. If you're in an industry that has a worse multiple, just be accurate with it so you're getting a realistic picture of what the potential returns are. The valuation or the valuation cap. This is another really critical number to put in your evaluation tool here. This is the amount of money that you're expecting the investor to essentially pay for your company. What's your company worth at this time for the investment that's being requested? In this particular case, we have a $2 million valuation cap put in here for the tool's sake. Next are your option pool and your other rounds of funding that you're going to get over the course of the time that this investment takes place. If you're at a really early stage and you have not yet set up an option pool for your employees and your board members and all the rest, then using a 12.5% number is pretty fair. The number can range anywhere from 10 to 20%. 10's a little stingy, 20%'s pretty generous, so 12.5 or 15% is usually a good number to use. Now you're going to raise money beyond this round, so you want to make sure you're accounting for what percentage of your company you're going to sell in the rounds subsequent to this round. In this particular example, we've got an A round where you're going to sell 20% of your company and a B round where you're going to sell 20% of your company. You can add in additional rounds, C rounds, and other rounds where you're going to sell additional percentages of your company. The reason this is important is because from an investor perspective, they want to know how much they're going to be diluted. And as you sell more and more rounds in your company, the investor they want to know how much of the company they are going to be left with based on their initial investment. The next thing you want to know is your total addressable market, your serviceable addressable market, and your serviceable obtainable market. We also call that TAM SAM SOM. We have a whole video on that you can check out about how to find and calculate your TAM SAM SOM. But these are three critical numbers in valuing your company at this point in your fundraising journey. So in this particular example, we have a company that's got a $5.25 billion total addressable market. That's a worldwide market for exactly what it is that they're selling as their solution. A serviceable addressable market, which is usually, in our case, the US version of that same market size. And your serviceable obtainable market is really the first 3 years of sales projections from the bottom up. The TAM and the SAM, you can research from the top down. The serviceable objectionable market or your 3 to 5 year sales forecast should be from the bottom up. When you've entered all of those numbers, it will calculate a bunch of the things that you see here on the right, including what percentage of ownership the investor will get based on the $100,000 at a $2 million valuation. It calculates the required exit for the founder to get their 40x return. And it also calculates the expected dilution as you raise more money over the course of your journey as a founder and as a company. For this particular example, the $100,000 raise at a 40x returns on a $2 million valuation cap, that means that this investor is required by their standard to get a $7.1 million return off of the $100,000 that they've invested. Based on the fact that you get a 4x industry multiple, in other words, somebody will acquire your company for 4 times your sales. That means that this particular company in this example has to have $36 million in sales for this projection to be true. In addition to needing $36 million in sales for this projection to be true, investors like to know, okay, well, that's great, but what percentage of the market does the company have to capture in order to get there? So you know whether or not that's a realistic expectation. Given the $5.25 billion TAM and the $2.3 billion SAM, in this particular case, the company has to achieve less than 1% of the TAM and about 1.5% of the SAM. Now, both of those, you can see these things are outlined in green. Green means go. That's a good thing. If we were to change the valuation cap in this example to $10 million and leave everything else the same, you can see that now these boxes are outlined in red or yellow in the case of SAM, which means that it's not a good investment from an investor's perspective. Why? Well, the required exit is now $714 million, which means that the company has to achieve almost $180 million in sales. That, while possible, is unlikely. So it's not as good of an investment from an investor's perspective. Let's play with this for a second and see exactly kind of where the break-even point is here. So we know $2 million would work. We know $10 million is probably too high. So let's go back to our valuation and change that to, let's say, $8 million. Well, $8 million is not much better than 10. Let's try $6 million. Well, we're starting to get there. We've got the percentage of SAM now under 5%, which is good. The percentage of TAM, actually getting 2% of your TAM, that's a big lift. And you can see that we're now in the yellow zone. So $6 million on this particular setup, you're right on the borderline. If we brought this down to 5, yeah, now we're still a little bit of green and yellow mixed, but it's much closer to a realistic investment for this particular company with this particular setup. And you can see, you can just use the tool to change things around. You can play with different sizes of dilution. You can play with different sizes of sales multiples. You can play with different sizes of investments and different types of multiple returns on this until you arrive at a place that you know that the offer that you're making to the investors is something that's going to be reasonable for them to invest at. Thanks for tuning in today for our lessons on our valuation calculator. It's free to use. Follow the link below. All you have to do is register and you can keep using it over and over again. Jeff Sailing, Startup NB, signing off.